In September 2008, the largest financial crisis since the Great Depression reached its climax as the American investment bank Lehman Brothers filed for Chapter 11 bankruptcy, bringing its 150-year trading history to a bitter end. An event which was, and still is, the largest bankruptcy in American history. But it wasn't just American investment banks which felt the pain. In the months and years following, it's been estimated that over 30 million people lost their jobs worldwide, with some economic models putting the total cost of the crisis at between $20 to $30 trillion. But what the hell happened? How did the bankruptcy of a large investment bank trigger one of the largest economic catastrophes the world has ever seen? Well, to really understand this issue, we need to go back in time to where our story begins, all the way back to the mid-80s. So, the global financial crisis didn't just happen out of the blue. It was enabled by the large-scale structural shifts in the global financial industry, which happened in the 20 to 30 years prior to 2008. Now, these structural shifts were mainly the result of the sweeping deregulation of the financial industry, which really got going from the mid-80s onwards, under the leadership of figures like Ronald Reagan of the US and Margaret Thatcher of the UK. As you probably know, Reagan and Thatcher were massive free marketeers. Basically, they believed that embracing the free market was the most efficient and productive way for an economy to run, and that regulation and government interference should be kept to a minimum, as they believed this caused inefficiencies and stifled economic growth. Now, a key industry that Reagan and Thatcher set their sights on was the financial industry, which was at the time highly regulated, which they thought was terribly inefficient and needed to be fixed. So, over the course of a number of years, the financial industry was deregulated, giving banks and financial companies much more freedom. Initially, this deregulation had lots of advantages. For example, it enabled increased competition in financial markets, leading to better products and lower fees for consumers. But the aspects of financial deregulation that we need to focus on for this story is that firstly, it allowed finance to become much more globalised, as barriers to international flows of money were reduced significantly, which meant that the global financial system became much more interconnected, like a web of global finance. And secondly, banks and financial companies were allowed to innovate, enabling them to come up with new products like financial derivatives and securitized assets, which we'll talk more about later. Now, aside from their free market ideology, one of the main reasons why leaders like Reagan, Thatcher, and later on Bill Clinton were so keen on this financial deregulation was because there was a massive push to increase home ownership in places like the US, the UK, and other parts of the world. Think, who doesn't want to own their own home? It's literally part of the American dream. And if a politician can massively increase home ownership in their country, then chances are they'll have been seen to do a good job. But why would deregulating the financial system lead to increased rates of home ownership? And what's this got to do with the collapse of Lehman Brothers and the whole 2008 crisis anyway? Well, these points are actually central to understanding what happened in 2008. And to understand the link, we're going to have to dive into some finance, starting with one of the most well-known financial products out there, mortgages. So for a bit of context, before the deregulation of the 80s and 90s, mortgages were common but reasonably difficult to get. There were a lot of hoops you had to jump through, and banks would typically only give out mortgages to people who had a pretty chunky deposit, usually 20% or more. And you also needed to have a pretty sizable and stable income stream, as well as very few other debts to your name. And because of the tight regulations at the time, banks could only give out so many mortgages before they simply ran out of cash. Think of it like this. In the days before deregulation, banks were small and localised, and typically held onto a mortgage until it was fully repaid. It was very difficult to sell mortgages between banks so that they could get their cash back quickly, like they do all the time nowadays. So back in the day, if you wanted to get a mortgage, you had to go to your small local bank. But let's say that last month, your bank gave out 50 mortgages, and now they don't have enough cash left to give out any more. In this situation, you'd be pretty stuck, and you just have to wait around for your bank to recover some of the cash from their outstanding mortgages before they had enough to give out any more, creating a natural bottleneck. So people like Reagan and Thatcher looked at this system and thought that if we want to increase the rates of home ownership, then we should just make it easier for people to get mortgages. And we can do this pretty easily by just taking away some of the artificial restrictions that are placed on banks through regulation. In other words, if we were to deregulate the industry, we can just let banks get creative with mortgages and let the free market run wild. And over the course of the 80s and 90s, this is exactly what happened, with one of the most important developments being the widespread use of something called the mortgage-backed security. Now, the mortgage-backed security is central to the story of 2008, so it's really worth taking a minute to understand exactly what it is and what it means for the housing market more generally. Okay, let's say you're the manager of a local bank in upstate New York, and on your books you have 100 outstanding mortgages to local residents. Now, at the moment, you're pretty happy with this. Each month you're getting consistent cash flows from the 100 outstanding mortgages that you own. However, you've got a lot of money tied up in these mortgages, and there's a risk that some of them could default, in which case you'd have to go through the effort of repossessing the house and trying to sell it on the market to recoup your money, which would be time consuming and would inevitably incur some fees. But one day you get a phone call from a big investment bank on Wall Street. Let's call this bank Lehman Brothers. And they offer to buy 50 of the outstanding mortgages off you. As in, Lehman Brothers will literally pay off these mortgages so that they can then own them and collect monthly repayments from the homeowners directly. Now, for you as the bank manager, this would be great, as it gives you the opportunity to de-risk your balance sheet, and you'd get a whole lump of cash which you can use to invest in new mortgages, which is always good, as the bank charges a flat fee every time they issue a new mortgage, which is very profitable. So you agree to the deal, and Lehman Brothers take 50 mortgages off your hands. But it's not only you that Lehman Brothers have contacted. In fact, they've purchased the same number of mortgages from 20 local banks across America and now own a portfolio of 1,000 individual mortgages. So why have they done this? What have Lehman Brothers got to gain from owning 1,000 mortgages? Well, what they're going to do is securitize them and create a mortgage-backed security. Essentially what this means is they're going to create a special type of company called a special purpose vehicle and place the mortgages inside of it. They can then split the special company into pieces or shares, which can then be purchased by external investors. In other words, the investment bank has securitized the mortgages, i.e. external investors can now invest in a slice of the pool of 1,000 mortgages. If you know what an investment fund is, you can basically think of a mortgage-backed security as an investment fund which holds thousands of individual mortgages rather than thousands of individual stocks. Now, this might all sound pretty pointless to you. What benefit does this whole thing have to anyone? Well, it's actually a really good system when it works. A mortgage-backed security provides a low-risk investment opportunity for people like pension funds and asset managers, and they enable small banks and mortgage lenders to free up the space to issue new mortgages to new homeowners, therefore fixing the bottleneck problem we saw earlier. And throughout the 80s and 90s, mortgage-backed securities were incredibly popular and were working very well. Investors got their low-risk returns. Investment banks made a hell of a lot of money on their fees, as did the small banks and mortgage lenders, and more individuals could access mortgages and get on the property ladder, as banks had much more freedom to issue them. So things are looking pretty rosy, right? It's the late 90s, investors are happy, home ownership is on the rise, and the Reagan-Thatcher neoliberal dream is in full swing. But unfortunately, like any good story, the good times can't last forever. And as we enter the new millennium, the MBS gravy train starts to mutate into one hell of a shitstorm. As many of you know, many economies, especially the US, experienced a major slowdown and recession due to the dot-com bubble of 2000 to 2001. And as interest rates plummeted in an attempt to kickstart the economy, many investors around the world were looking for new, low-risk investments which offered a better return than the measly 1.5% that they could get from government bonds at the time. So, lo and behold, a lot of institutional investors turned to American mortgage-backed securities, as they offered a pretty decent interest rate for very low risk. After all,
well, they're mortgages. And who the hell doesn't pay their mortgage?
And if a homeowner did default on their mortgage, the bank could simply repossess their house and sell it on the open market. And as house prices were rising pretty quickly at the time, recovering this value would be no problem at all. And of course, the investment banks were very glad of this increased demand for mortgage-backed securities, as it meant that they could make more and earn loads of fees for doing so. And so they began buying up more and more mortgages to meet the demand. So because of this, small banks and mortgage lenders were very happy to give out mortgages, as they had the confidence that they could turn around and pretty much immediately sell it to a big investment bank. So no longer having to worry about the risk, but still being able to pocket a decent fee along the way. So again, everything looks to be going swimmingly. People have easy access to mortgages, home ownership is on the rise, the banks and investment banks are making money, and investors are still happy. What's not to like? Well, the problem starts when the mortgage lenders run into a natural bottleneck. There are only so many people with chunky deposits, stable incomes, and a good credit history, i.e. there are only so many ideal candidates for a mortgage. So what do the banks and mortgage lenders do? Do they just slow down on giving out mortgages and wait for the right people to come along? Absolutely not. Why would they, when they can just give out mortgages to less desirable candidates, i.e. people on lower incomes or with a bad credit history, and immediately turn around to an investment bank and sell it on, and therefore not have to worry about the risk? Now, this isn't necessarily a bad thing, so long as everyone is aware that these mortgages to less desirable candidates, also known as subprime mortgages, are more risky, as in the homeowner is more likely to default on the debt, as they're on a lower income or have a history of bad credit. But unfortunately, things weren't that simple. And with this, we're really getting to the crux of the whole story. As a bit of background, investment products such as mortgage-backed securities would usually undergo a review process where an independent body, known as a ratings agency, would come in and review the investment, scrutinise what's in it, and then give it a rating based on how risky it is. Very low risk investments, like government bonds for example, might get a AAA rating, which is the highest you can get, whereas more risky investments, like stocks in tech startups for example, might get a B or a double B rating. And really risky investments, which aren't really worth the paper it's written on, would normally get a C or a D. So as the mortgage lenders were giving out mortgages to riskier and riskier candidates, which were then being bought by the investment banks and put into mortgage-backed securities, you'd expect the rating agencies to start to downgrade the risk rating on these securities. Well, unfortunately not. You see, the big ratings agencies, such as Standard & Poor's and Moody's, were not independent by any stretch of the imagination. They were pretty much bankrolled by the big investment banks and would give out AAA ratings to whoever asked for them, no matter how risky the investment was. And this basically meant that investment banks could create a mortgage-backed security, fill it full of super risky mortgages, go down the road to a ratings agency, stamp it with a AAA rating, and then offload it to investors around the world and pocket huge fees in the process. So essentially what we have here is a perfect storm. Mortgage lenders no longer care who they give out a mortgage to, as they know that they can immediately turn around and sell it to a big investment bank. And the investment bank no longer cares about the risk of these mortgages, as they know that they can package it up into a mortgage-backed security, go and get a AAA rating, and then immediately offload it to unsuspecting investors around the world. Perfect, right? Everyone wins and everyone makes a shit ton of money. Now, this web of fraud and perverse incentives held strong for a good few years in the early to mid-2000s, and as things held strong, with the world blissfully unaware of what was going on, the levels of fraud and complexity just kept growing. Once the mortgage lenders had cottoned on to the fact that they could literally give out mortgages to anyone and they would still immediately be bought by a big investment bank, they started to literally give mortgages to anyone, even if they had no income, no job, and no assets.
Well, my firm offers ninja loans. No income, no job.
And what's more, the mortgage lenders started to get really creative with the mortgages they gave out. Many would have short-term periods of very low interest rates, which would suddenly jump up after a period of time. This meant that people with literally no money could suddenly afford to move into a massive house, but would then be hit with a huge mortgage bill once their teaser rate expired. These mortgages were known as subprime adjustables and were becoming more and more common. And once these terrible mortgages were in the hands of the investment banks, rather than packaging them into a mortgage-backed security, which at least needed some good mortgages in order to get the AAA rating, they instead packaged them into something called a collateralized debt obligation, or CDO, which is basically a mortgage-backed security full of super risky mortgages, but in the eyes of the ratings agencies were considered highly diversified, and so eligible for a AAA rating. So, as you can imagine, these CDOs could boast great returns, as they were full of predatory mortgages with sky-high interest rates, but were also considered to be super low risk, hence the AAA rating. And so these CDOs were incredibly popular with investors around the world, who were blissfully unaware of the absolute horseshit that they were, as they just accepted the AAA ratings that the ratings agencies had given to them. And what's more, because they were so popular, and because everyone was making so much money from them, there existed a massive market of speculators which were betting on the performance of the CDOs. In fact, for every $1 that was invested in mortgage-backed securities in CDOs, there was up to $20 which were betting on the performance of these securities, which is just ridiculous. So you probably sat there thinking, this doesn't make any sense at all. Why the hell would investors be speculating so much money on the performance of something which is essentially just made up of super risky mortgages that are likely to default? And you'd be right, it doesn't make any sense. It was absolute chaos at this point, and to add to the complexity, there was also a huge market for insurance products on mortgage-backed securities and CDOs, known as credit default swaps, which would pay out if the underlying securities were to fail in the event of large-scale mortgage defaults. Remember AIG used to sponsor Manchester United back in their glory days? Well, these guys issued billions worth of credit default swaps, as they believed mortgage-backed securities and CDOs to be rock solid and would never fail. So they thought that issuing these insurance products was literally like printing free money. Spoiler alert, AIG would have gone bankrupt in 2008 if it wasn't for a generous government bailout of $180 billion. Okay, this is getting pretty complex, so let's recap on where we're up to. Mortgage lenders are giving out mortgages to anyone with a pulse, as they know that they can quickly sell off any mortgage to a big investment bank, and so they don't need to worry about any of the risks that are involved. And more of these mortgages are predatory adjustable rate mortgages, which have sky-high interest rates once the teaser rate expires. The big investment banks then take these terrible mortgages and package them up into mortgage-backed securities and CDOs, which are then given a AAA rating by the ratings agencies, when in reality they should really be given Cs or Ds. These investment products are then offloaded to institutional investors like pension funds and asset managers around the world. At the same time, we've got a massive market of speculators which are betting on the performance of these mortgage-backed securities and CDOs. And we've also got insurance companies which are giving out credit default swaps, which will pay out if the underlying securities fail. So hopefully you can now visualise this international web of fraud and dodgy investments, which is all centred on the American housing market and solely relies on American homeowners paying their mortgages on time. But as we all know, this web of shit will only hold for so long, And as we enter late 2007, things start to go horribly wrong. So, as we're all expecting, some of the people with no income and no assets will start to miss their mortgage payments, and so the bank will have to come in and repossess the house. Okay, no bother. We can just sell the house on the market to recoup the value, right? Well, yes, but the trouble is that quite a few people are defaulting on their mortgages recently, as shock horror, people with no income and no assets will struggle to find thousands of dollars each month for a mortgage they simply cannot afford. So as more and more houses are repossessed and put back on the market by the banks, house prices begin to flatline and then start to decline as supply starts to outpace demand. At the same time, the big investment banks are starting to get a bit worried about the rise in default rates, and so start to refuse to purchase these terrible subprime adjustable mortgages from the small banks and mortgage lenders. Mortgage lenders then become stuck with these terrible mortgages, many of which enter default, forcing them to repossess and try to sell yet more houses. And as house prices are falling at the moment, mortgage lenders try to sell these houses as quickly as possible to try and recoup some of their money before their value drops too much, which only adds to the downward pressure of house prices as more and more come up for sale really quickly. At the same time, people are finding it more and more difficult to get mortgages to purchase these homes, as the same mortgage lenders are nervous to give out new mortgages, as they know that the big investment banks aren't as keen as purchasing them as they once were, making it very difficult for the mortgage lenders to sell their repossessed homes, pushing prices down even further. This is putting loads of pressure on mortgage lenders and small banks who are stuck with a load of repossessed houses that are quickly losing value and won't sell, forcing many to file for bankruptcy. So as mortgage lenders go out of business and refuse to give out new mortgages, homeowners become stuck with their predatory adjustable rate mortgages and are unable to refinance, leading to yet more defaults and making the problem even worse. So here we have it. The dominoes have started to fall and mortgage defaults are snowballing. And it's only a matter of time before the mortgage-backed securities and CDOs, which have infiltrated the web of global finance, begin to fail. And as 2007 turns into 2008, this is exactly what starts to happen. As the securities begin to fail and the CDO ship machine starts to fall apart, the big Wall Street investment banks start to bleed and feel the pain. And during 2008, the big banks do all they can to try and save themselves, committing some of the worst acts of fraud and barefaced lying the finance world has ever seen. But it's not enough. The ship has sailed and there's no going back. The mortgage default rates are simply too high, and all of the mortgage-backed securities, CDOs, and speculative bets that are tied to these mortgages all begin to fail. And so we end up where we started, in September 2008, watching Lehman Brothers finally go under, ending 150 years of trading. Other big names such as Morgan Stanley, Goldman Sachs, and Merrill Lynch would have met the same fate if it weren't for the massive government bailouts which kept the world's financial systems afloat. In the raw pursuit of money and profits above all else, the world's financial system, led by the American investment banks, ratings agencies, and mortgage lenders, killed consumer and business confidence and plunged the world's economy into the biggest recession since the 1930s, with many economies still feeling the aftershocks of the crisis to this day. Okay, thanks for sticking with me through that. I'm conscious that this video is getting pretty long, but there are plenty of areas of the crisis that I've not yet touched on, such as what happens immediately following the crash. So if you'd like me to make a part 2 to this video, please leave me a like and a comment below. And if you've enjoyed this video, you might find some of our other videos on the channel interesting, so please take a look. And please consider subscribing if you've enjoyed. Thanks for watching.